Okay, disclaimer. The information presented in this video should not be construed as financial advice regarding the purchase of any cryptocurrency or the use thereof. Definitions. Miners. This is the term used for the computers running special software that performs various functions relative to the blockchain. Cryptography. This is the term used to refer to the practice of both encrypting and decrypting information. Cryptography is used to encrypt information that is sensitive or classified. People skilled in this are called cryptographers. Hash. This is the term used to describe the result of using the SHA-256 algorithm on a string of characters making up a document of some sort. The document could be an email or a text document of some kind. A hash would resemble the following string of characters. 256 bits is the same as 32 characters because it takes 8 bits to represent one character. SHA-256, this is the acronym for the secure hash algorithm that yields a 256-bit or 32-character hash. It is a method developed by the cryptographers to verify the information transmitted across the internet has not been altered either intentionally by bad actors or accidentally by some sort of glitch in the process of being transmitted. More details on this later in this video. What is a blockchain? A blockchain is a digital ledger. Blockchain is the term we use to describe a chain of blocks of information tied together cryptographically, making the blockchain immutable or unchangeable is what that means. What makes it immutable is that each block begins with a SHA-256 hash of the previous block, and at the end of each block it contains the SHA-256 hash of the current block. This makes it impossible to alter without being readily detected. This is a high-tech version of the old paper accounting ledger where each ledger was sequentially numbered with a starting and ending date, and each page within the ledger was sequentially numbered. This makes it easy for an auditor to detect when a ledger with a sequence is missing or a page within a ledger has been removed. There are 3 types of blockchain. Private blockchain, this is a blockchain that's used internally by an organization and is controlled entirely by that organization. While it has the potential to be secure, the vulnerability that exists due to a very small group of people controlling it makes it easy for those in control to conspire to violate the integrity of the blockchain. Then there's the public blockchain, more secure, because the public can keep an eye on it and say something when they see something that doesn't appear to be correct or appears to be amiss. Public and distributed combined, this is the most secure. I will go into what a distributed blockchain is, how it works, and why it is more secure next. Public distributed blockchains. A public and distributed blockchain is one that anyone can look at any time. A distributed blockchain is one that is maintained by a large group of independent miners, each running a copy of the same specialized software, each having a vested interest in making sure that the integrity of the blockchain is maintained. With that said, going forward, we will be talking about the blockchain technology in terms of its use for cryptocurrency, specifically Bitcoin, but much of what we cover here will apply to most every cryptocurrency out there, since they all, with few exceptions, work much the same way. So let's start by discussing miners. Miners are special computers running specialized software. Anyone can configure their computer to be a miner. Miners perform 2 very important functions. One, they verify and process transactions, and secondly, they help to bring new bitcoins into existence. Verify and process. Every transaction must be verified and processed. Verify means verifying the entity attempting to send the bitcoin actually owns it. This is done by verifying the pedigree of the Bitcoin all the way back to when it first came into existence. This information is all stored on the blockchain, so it's easily done. Processing: once the pedigree of the Bitcoin trying to be sent has been verified, the Bitcoin is transferred from the sending wallet to the receiving wallet, and that transaction is then included in the next block on the blockchain. This is done by multiple miners, and a consensus must be reached regarding the validity of the transaction before it will be included in a block on the blockchain. Creating new Bitcoin. Each time a new block is added to the blockchain, the miner creating the new block is rewarded with new Bitcoin. For this reason, miners compete for the privilege of creating the next block. The competition involves literally guessing a very complex number. The miner who guesses the number correctly gets to write the block and thus receives the block reward, and the cycle repeats. A new block is created every 10 minutes. If the block creation time increases, the complexity of the number to be guessed will decrease, and if the block creation time decreases, then the complexity of the number to be guessed increases. The objective is to keep the block creation time about 10 minutes. This is how Bitcoin comes into existence. This will continue until the last Bitcoin has been created. With Bitcoin, there will only be 21 million ever created. Unlike fiat currency, new Bitcoin cannot be just created on a whim. This is one of the redeeming features of cryptocurrencies. Purpose of a blockchain. A blockchain can be used to store almost any kind of information. The most well-known use of the blockchain would be cryptocurrency, such as Bitcoin. With that said, however, a blockchain can be used to store records of all kinds, such as birth and death records, real estate records, tax records, medical records, etc. Basically anything that you would want a permanent record of that once recorded cannot be altered. The most secure type of blockchain is the one that is both public and distributed. An example of this would be the Bitcoin blockchain, which meets both criteria. A distributed blockchain is secure because it is maintained by a large number of miners, all doing the same job. All miners have a vested interest in making sure that the integrity of the blockchain is maintained. The perfect currency. It's anonymous. Bitcoin is anonymous. A Bitcoin wallet has no name associated with it. The only thing that is recorded on the blockchain is the wallet address of each wallet. You can own any number of wallets. A wallet is almost like a numbered bank account in a Swiss bank. Quite literally, the only way anyone can associate a name with a wallet is when you go to an exchange and use your bank account, debit or credit card to purchase Bitcoin. At that point, they know who purchased the Bitcoin, but once that Bitcoin has been sent to a different wallet address, there is no way to know who actually owns the receiving wallet that it went to. The owner could be anyone, anywhere in the world. Bitcoin can easily cross borders instantly, and no government authority can control it or its use. Mass adoption. When will it happen? Mass adoption. While the technology for cryptocurrency is well established and well tested, currently, at the time of this video being produced, an estimated 3% of the population has embraced Bitcoin specifically and cryptocurrency in general. Why is this? Well, for one, many have never heard of it, and of those who have heard of it, many of those know little or nothing about what it actually is and how it works. So educating the public is necessary. This video is an attempt to do just that. The second important factor needed for mass adoption is ease of use. I will address that next. Business use. As a payment, it is better than a credit card because unlike a credit card, there is no such thing as a chargeback. A Bitcoin transaction is both irrevocable and irreversible. There are two primary reasons that merchants are reluctant to embrace it as a payment method. The first is the risk of accepting Bitcoin and the hassle of converting it into cash. The value of Bitcoin can be volatile, and as such, the business could lose money during the short period of time between when they accept it and when they are able to convert it or exchange it for dollars. Given that many merchants operate on a very thin profit margin, this could easily wipe them out. The second reason is ease of use. At the time of this video, nobody has produced a point of sale device that will make it easy for a merchant to begin taking Bitcoin. With that said, the company that comes out with a POS device that also eliminates the risk for the merchant by instantly and seamlessly converting the Bitcoin into cash will be hugely successful. More on that coming up. This is an example of a point of sale terminal. This would be the screen facing the consumer, and it would have on it what the transaction amount is that the cashier would have typed in, and then it gives the consumer the option of clicking they're paying in cash, clicking they are paying by credit, or clicking the crypto button. If they click the crypto button, it's going to pop up that QR code that you see, and the instructions below will be scan the QR code, confirm the amount, tap send, and that'll be done with an app that's on the customer's phone. More on the point of sale device. The point of sale terminal, as previously described, is key to the wide adoption of Bitcoin. It has to be super easy and convenient for both the merchant and the customer. The public is used to the ease of use of debit credit cards. When there is an app for your phone that comes up ready to scan the provided QR code, and all you have to do is scan the code, confirm the amount, and hit send, then people will use it. With that said, however, people in general are resistant to change, so you have to provide some kind of incentive to nudge them in that direction. When it gets that easy, the adoption of Bitcoin as a payment method will skyrocket. Ease of use is the key. Ease of use for the merchant, ease of use for the consumer. When these two things happen, watch out. It's coming, my friends. Okay, this is a demonstration of the SHA-256 algorithm, and basically it produces a 256-bit code as shown here for anything that you type in up here. So, for example, if I type in my name, STEPHEN, and it shows the 256-bit hash. Hash refers to the result. If I change that by removing the N, it changes the resulting hash. So as you can see, it really doesn't matter the length of the text that you run through the algorithm. It will always produce a 256-bit result. And this is used to prove the integrity of something. If somebody sends me an email, for example, and the original email named Stephen, and it would have this hash result. But if somebody changed the spelling to STEPHAN, it totally changes the hash result. So I can know that if somebody sends me an email and they also send me the SHA-256 hash of that email, I can then run the email through the SHA-256 hash algorithm, and if it produces a different hash, then I know that it has been altered. So like I said, it is used to prove the integrity of information. So the way this is used in a blockchain to preserve integrity of the blockchain is every new block that is added to the blockchain will begin with the hash of the previous block and end with the hash of the current block, which includes, of course, the hash for the previous block. So you cannot alter the previous block, because then the hash that's included in the next block would not match up. And you can't alter the current block after it's been written without altering the hash for that current block. If you enjoyed this video, please like it, share it, and most importantly, hit that subscribe button. Thanks for watching.